Thank you very much. Thanks for the wonderful presentation, Juan Nick. It was very enlightening and also very encouraging to see the steps that Coop is undertaking. Thanks again for joining us, my colleagues from Macquarie, Charles, Mark, and Tom. I'd like to kick off this session with a bit of a shameless plug. Macquarie has been doing quite a bit of work on the ESG front. Charles and myself have lost a bit of sleep trying to put together some of this research for clients like Juan Nick, and turning unstructured data into something that's structured and that we can draw insights from is no easy task. And I certainly do appreciate Juan Nick continuing to push the corporates to disclose more data. I think data is certainly key to a ESG investment framework. But of course, I think we are barely beginning to scratch the surface on what is being done, and there's a lot more work to do. So let me maybe give a bit of context to our conversation today by getting Charles to kick things off. ESG investment has been growing rapidly. Perhaps you can give us a bit of numbers to work around, AUM that's moving to this space, and maybe the trajectory as well, Charles.
Thank you, Ben. So back to that. It's actually a surprisingly tricky question to answer. So how quickly is ESG growing? And that is because there's so many different ways to measure the AUM, and it's being measured in infinite ways. But basically all of these ways are showing strong growth. So one number that always comes up, Juan Nick mentioned that Coop became a signatory to PRI, Principles for Responsible Investment, in 2018. So there's well over 100 trillion US dollars in AUM that is signed on to the PRI. Now, which is great. What's a little bit more difficult to show, though, with those figures is how much more serious the signatories are getting. And I'm sure Juan Nick could add a lot that I wouldn't be aware of as well. But the requirements to remain a signatory in PRI, and basically the requirements from asset owners for investment managers to be, quote, ESG friendly or sustainable fund are growing rapidly. And I think one way we could capture that is we look at Morningstar puts out quarterly figures for AUM that is going into sustainable funds. It's a much narrower definition, but that figure has jumped globally from $1 trillion at the beginning of last year, which was a doubling from the previous year, to $2 trillion US dollars at the beginning of this year, and $4 trillion today. Now, that sort of acceleration, given how big the numbers are getting, can't last forever. But a really interesting point here is that the overwhelming majority of that is still out of the EU. So we're just starting to see the tip of that growth from Asia in particular. And that's where we see the acceleration. Also, something that Juan Nick mentioned, we are seeing all of the regulators, literally all of the regulators around the region, at least for the markets that we cover, come down with much more codified requirements for what a fund needs to do to be, quote, green or sustainable or ESG friendly. And this is, we could take what's happening in the EU as sort of a blueprint, and it is having massive impacts there. And we're starting to see that in Asia as well. And to the point on data, Ben, and I appreciate the pain that you've been put through, as well as Mark, in rolling out our own ESG scores. On data, all of the exchanges / regulators, but mostly the exchanges around the region, are pushing through first comply and explain, and tightening regulations, so comply ESG data points that corporates need to report. And we could also see this at the ASEAN level with the new green taxonomy, which I think is quite impressive as well. So, and then finally, anecdotally, if I look back 5 years ago, my requests from our clients, investment managers, for ESG issues were mostly from someone who is somehow associated with Europe. And we could even go so far as to say the Nordics. Whereas over the course of the past 2 years, we're seeing now, and over the past 6 months especially, an acceleration in the Asian domiciled funds, and working with the Asian sovereign wealth funds and pension fund managers that are pushing ESG very, very strongly and looking to catch up.
Thanks, Charles. The next question is for Puan Nick. So, what is Co-op's preferred strategy for ESG investing? Engaging with management to transition, or perhaps voting with your feet by selling and buying the underlying assets?
Thank you for that, Mr. Ben. As I mentioned earlier, Co-op has incorporated ESG into our investment decision-making processes. We have our own internal ESG rating. We also have a dedicated responsible investment team who looks at ESG adoption by our investing companies. We are active in shareholders activism. We conduct about over 20 engagements in a year where we deep dive into ESG specific issues. Since Co-op is a pension fund with relatively large shareholding and long-term investment horizon, so we prefer to engage in a bit more structured way, and also to clearly state our expectations and also identify rooms for improvement for our investing companies. So we expect, for example, the investing companies to provide official board-approved time-bound commitments that are acceptable to Co-op. So the rate of progress, for example, and the improvements and the steps that they have taken. And we will monitor such progress of the pledges. But having said that, if there are fundamental ESG breaches, especially poor governance, which we find not justifiable, and that involves senior management, we will not hesitate to divest immediately. This is to send a clear signal that while we are a long-term investment, we have a long-term investment horizon, and we are willing to engage with companies and to hold their hands in order to guide them to improve their ESG practices. It is important that, I think, for us to send a clear signal to the capital market that serious ESG breaches will not be tolerated. And we have done so in the past.
Thanks, Puan Nick. That's actually really good to hear. And perhaps Charles, Co-op's in a slightly different position from a lot of global funds, being very domestic-centered. How does Co-op's approach differ from what the global funds are doing? Do you see any divergence here?
No, actually, what Puan Nick just articulated is broadly in line with what we see as best practice for global funds. Now, the point there as well, though, is that this is very dynamic. This is live. The requirements to demonstrate the impact and the effects of engagement and stewardship have really gotten much greater. And we can see this through the engagement reports from all of the big fund managers, the big global fund managers, that whereas even 3-4 years ago, these managers could get away with saying they were engaging with management, but they didn't vote against management because they want to keep the channels open. They can't get away with that now. There has to be a very clear, very clear impact if management's not doing or at least reacting to what the investors are saying. Now, the other thing is on exclusions. So exclusionary policies still certainly exist, but it's a very small share of, again, sustainable investing. There are exclusions, long-standing exclusions around tobacco, around cluster bombs, around weapons more broadly. Now, to that list has been added thermal coal. And Mark certainly will have more views on this, but really in terms of fossil fuels, for the most part, it's really just thermal coal has been targeted. And we could talk about the effect or lack of effect around that later. But exclusions is a small part versus that engagement and stewardship piece, which is really growing in importance.
Thanks, Charles. Maybe I'll direct this one to Puan Nick first. So when you take that stewardship approach, managing the transition, does the burden of being a subject matter expert fall to you, or do you still have to rely very much on the corporates? Do you tell them what to do, or do they tell you what they're going to do? How do you draw that line?
Yeah, thank you. We expect our investing companies to keep abreast with the latest sustainability practices in their respective industries, including but not limited to climate change. They should benchmark their practices against their peers, both locally and abroad. And to achieve this, they might need to recruit excellent talents with the required skill set and training their existing officers to be the subject matter expert. Point I would like to stress here is that I believe sustainability should not be the role of any one section or focus group in the organization. Rather, the company should ensure that their board of directors, senior management and officers are given a regular and sufficient training, which include conferences such as this one, to equip them with the relevant skills that enable them to incorporate sustainability consideration into their tasks and roles. This would include their board of directors. So, for example, under the updated Malaysian Code of Corporate Governance issued by SC in April this year, it was stated that the board shall take appropriate action to ensure they stay abreast with and understand the sustainability issues relevant to the company and its businesses, including climate-related risks and opportunities. But having said that, we Coop certainly do not rely on companies to tell us what needs to be done. I believe there needs to be that check and balance in place, and investors should have their own internal capabilities in ESG to analyze and benchmark ESG practices by the investing companies. So while we acknowledge that investing companies subject matter experts would and should have appropriate specific knowledge on what the company needs to practice and comply with, I feel that investors such as Coop should leverage on our diversified investments to basically benchmark the company's practices against their peers that are also in our investment portfolio. As I mentioned earlier, that we have a dedicated responsible investment team at Coop. We have 5 officers currently, and we are still building the team with new hires. So we actually conduct an ESG analysis on the companies prior to engagement, and we are also some of us are also officially involved in committees and working groups set up by the regulators such as Bursa Malaysia and SC. And our team's analysis and engagements are based on GRI standards, which is the current best industry practice. Over and above that, our ESG ratings is based on our own set of criteria. And perhaps I can share a bit more in terms of our shareholders engagement process, where we actually engage with a few companies from the same industry during the same period or the same quarter. For example, we may engage with a few financial institutions during that quarter. So we will also consider the sector that we'd like to focus when we identify the companies to be engaged with for the year. So that would allow us to do kind of that peer-to-peer kind of comparison and benchmark, to also perhaps share information about the best practices done by the peers in the same industry. This is not limited to, of course, the domestic industry, but it also must be benchmarked against the global industry leaders. So I would like to take this opportunity to emphasize that we expect our investing companies to adopt best-in-class ESG standards, and we will assist them in their journey by identifying areas that we expect to see improvements on based on our own assessment. Thank
Thanks,
you.
thanks, Puan Nick. And I just want to open up that conversation to Mark. You look at oil and gas companies, for example. It's a very complex industry. Is it reasonable that investors, were able to fully appreciate, some of the complexity of the decisions? And does that mean that we kind of have to depend on these companies to make the right calls at some point? What do you think?
Yeah, I mean, I think corporates certainly need to listen to their investors. Investors are uniquely positioned to look at what other industries are doing to improve their ESG profile and what the best practices might be. But I think corporates are generally quite discerning as to which investors they listen most to. Clearly, shareholders that will partner with the corporate over the long term are probably going to be more useful. Sort of traders. But yes, I think the investors quite often have quite a unique vantage point.
So, sort of moving on to the broad topic of how the ESG investing can make an impact. I think there was a recent example at change of board at Exxon, which caught a lot of people by surprise. Do you think that such drastic changes need to be done in order to get the change you want to see? And maybe directing this at Nick, do you think companies today have the sufficient expertise at management level? If you're a hammer, everything looks like a nail. If all you've done, for 20, 30 years in the industry is hammer nails, maybe you need fresh blood to come in. What do you think about that, Nick?
Yeah. Based on my observation of our investing companies, the management level, they are at varying levels of readiness, whereby some are more ready than others. We have stated explicitly in our voting guidelines that the board composition should capture the diversity of skills and expertise necessary for the best interest of the shareholders. So in this context, we expect the skills and expertise to reflect the industry that they are in, and therefore they are able to address any peculiar risks that the company is exposed to. So in the context of energy transition, we expect the management to have practical skills and expertise in managing the risk of stranded assets in particular, in view of the global move towards the low carbon economy. It is also important to have reps on the boards who are industry veterans or even young talents with the requisite technical skills. I feel that regardless of the experience that they bring on the board, it is also important that the company provides some regular trainings to their board to ensure that they are equipped with the necessary knowledge. Climate change is a new area, and even the experienced board members might need a refresher or a relearn on the latest disclosures and regulatory requirements. So I would like to emphasize here that the fact that what was acceptable, acceptable industry practices 3 years ago, might now fall short of expectation. Perhaps it is good at this juncture for me to stress the importance of the governance pillar, the G pillar. Personally, for me, when conducting analysis of the company's E and S pillars, it is important for the governance pillar to also be given due weightage. This is because to ensure the companies adopt sound E and S practices, it is important for the governance practices to set a clear tone from the top and to look beyond short-term profits. Instead, it must focus on sustainable profits. I also found that based on our observations during our shareholders' engagements, companies with sound governance practices are able to provide more accurate disclosure on their E and S data and practices, rather than, for example, greenwashing them or portray good labor practices when in fact the living condition and employment terms actually do not meet acceptable labor standards in the company.
Thanks, Nick. And directing this one at Mark, do you think the change of board at Exxon is a win, or demonstrating that ESG investing does have an impact?
Yeah, absolutely. I think that was a big wake-up call for a lot of corporates in the fossil fuels sectors. Activists can have a material impact in the boardroom. I think Exxon was an example of a company that didn't really appear willing to transition from their existing business. They were a winner within their existing industry, seen as the best in class on a lot of different metrics. And so perhaps that sort of arrogance had crept in, and they just weren't willing to pivot in this transition. And so it's going to be fascinating to see the change of direction within the company now that board shake-up has occurred. But for a company of that size, with so many capable engineers and great minds within the organisation, hopefully Exxon will play a much bigger role in this transition.
Thanks, Mark. This next question is for Nick again. So in the context of Malaysia, when it comes to energy, arguably there are limited avenues to invest or divest. Do you think this somewhat minimizes the impact of your ESG investing?
I don't think it as minimizing the impact of ESG investing. It has enabled us to engage more closely with the companies and scrutinize their long-term commitments. For example, such as the example I gave earlier on Tenaga, we monitor their sustainability plan. We engage with them both individually and collectively with Institutional Investors Council. We will monitor Tenaga's much lauded aspiration to have net zero emissions by 2050, which is a bold move towards decarbonization and RE, of course. With regards specific to debt capital market, we approach this a bit differently from listed equity. A majority of the larger power projects in Malaysia are funded 2020 debt equity. At Coop, we have different ESG guidelines for different asset classes. For example, equity and fixed income integrate the ESG factors differently. So bond investors have the capability to drive investee companies to incorporate sustainable considerations throughout the life cycle of the company's operations. They will have to identify and develop suitable ESG metrics in this space, specifically for power projects, since cash flows are ring fence, right? So these kind of metrics should be based on international best practices, and also to incorporate developments in Malaysia as well. So while the debt capital market or DCM also plays a role in promoting ESG, but I'm also quite mindful that it is widely acknowledged, for example, by PRI, that bondholders have less power to push for improvements in ESG practices as compared to, say, listed equity. So in the context of returns, financing for renewable energy project is abundant, so they can enjoy lower rate, therefore lowering financing costs. Traditional power generation projects, on the other hand, find it harder to get financing, and the rate would be higher. So as a result of that, traditional power generation project may have to pay for higher rate as they don't have much option. So the impact to debt capital market is more or less similar in our view. Coop may shift towards greener financing, but we may face the prospect of a lower return in terms of coupon payment. We're quite mindful that the general expectation from our stakeholders is for us not to embark on ESG investment, ESG specific investment, which will compromise returns. But as I mentioned earlier, we believe that as a long-term investor, the long-term financial as well as reputational risks outweigh the short-term gains. I'm also quite mindful of the risk of greenwashing. Therefore, I believe that it is important that such DCM investments to be put through the appropriate rigorous due diligence process, which must include ESG reviews.
Thanks, Puan Nick. And it's great you mentioned greenwashing, because that's one of the questions I have in front of me here. Maybe this one's for Charles and Mark. How can corporates convince us that they're actually making real change, and how do we sort of cut out the fluff? Because I think there's a lot of fluff that the corporates put in their annual report, when it comes to patting themselves on the back sometimes.
Yeah, thanks, Ben. I'll take a stab, then hand over to Mark, if that's okay. So there's no single magic bullet. I think we've alluded to, mostly Puan Nick has alluded to many of the key things that corporates should be doing in order to show that they're not just greenwashing. Now, one is in the area of metrics, or what they're really targeting. There are, at this stage, globally recognized and accepted metrics for different specific issues. So if we take climate, for example, TCFD is, that is reporting to TCFD, or Task Force for Climate-Related Disclosures, is a good first step. Signing on to Science-Based Targets Initiative, therefore showing that you have a clear and approved pathway to being Paris aligned, or being 1.5 degree to 2 degree aligned, would be a great first step. And then actually building that in all of those implications into strategies, so 5-year and 1-year strategies. And then, of course, from the governance perspective, absolutely critical. And we, as you would know, spend quite a lot of time on this as well. But the idea of incorporating those KPIs around climate, around ESG for management, and making a very clear link to board oversight are critical. And actually, that board oversight is something that is generally, in our work around the region, is generally still lacking. And those KPIs for remuneration, for example, we are way behind in the region versus Australia or versus North America or the EU. So there's a lot of work to be done there, and some encouraging signs that work is being done. And these are two elements I think that would really help to clear up the greenwashing accusations.
Yeah, just on my side, I would mention a couple of things. Firstly, there's a court case in Australia being heard at the moment between Santos, one of the companies that I cover, and a corporate group where they're being accused of greenwashing around their 2040 net zero target. And I think in that example, corporates do need to explain the technologies that they're deploying to get to that net zero target, or at least their intent. And it really needs to be a credible plan, or we will sort of see this type of activity, whether it be in courts or just public documents questioning the management practices. I think also I've seen a lot of companies that have gone sort of net zero early on in sort of FY1, FY2 through the acquisition of lottery offsets. I suspect that's something Tom will talk about a little bit later on in this panel, but I think that spectrum of quality in offsets is also something that's being more widely discussed now.
Thanks, Mark. And maybe just to shift the conversation a little bit, I think one of the criticisms leveled at ESG investing is that moving around the secondary price of assets may not necessarily translate to real world outcomes. Selling, not holding any coal assets doesn't change the amount of coal plants in the world, right? What are your thoughts on this sort of criticism of ESG investing? Maybe first pass this to Charles.
Thanks. There's certainly a backlash, and some of it is not in good faith, but I think a lot of it is against ESG investing and what you were just speaking to there, which would be exclusions or divestment of fossil fuel assets, for example, but it could be applied to any sort of ESG pillar. The idea being, of course, that if a publicly listed company where minority shareholders actually have some influence gets rid of those assets and sells it to private equity cap that isn't answering to anyone, then you're doing really. And it's an ongoing debate. It is absolutely an ongoing debate, but it's good because even a couple of years ago, there would just be immediate pushback on the idea with the assumption that anyone who's doing that, offloading these assets, is not valuable, is just doing that out of bad faith, with the idea that you should be holding on to the assets. Ultimately, I don't know. I am encouraged by the progress there. I think some of the more interesting or exciting projects that are underway right now, particularly around thermal coal, because that is the pointy edge of the stick in terms of fossil fuel assets and divestment. So there's a project that the ADB has taken on to buy up coal-fired power plants and then effectively retire them. And we also, during COP26, saw a similar plan launched for South Africa specifically. So this is brand new territory. Now, seeing how this can be successful and how we can actually deliver some sort of financial returns while shutting down these assets or running them, running them down in line with something that is aligned to Paris. That's really just starting to happen now, and I think those discussions are, valuable.
Thanks, Charles. And just expanding that conversation to Mark, how is this affecting your corporates' behavior?
Yeah, I mean, we're seeing numerous companies wanting to demerge the dirtier areas of their business and sort of separate them so they can focus their strategies on the new future-facing parts of their business. We're seeing that with AGL, BHP's doing it with their petroleum assets. Shell's talking about that in London now as well. As long as those dirty assets are still maintained with good governance and oversight, and there's a proper board and management structure around it, then those sorts of deals seem fine. But if it's going into private hands where there's just no oversight, the corporate probably does need to take some responsibility for those divestments. There's just one area I wanted to touch on in that regard. There have been a couple of instances in Australia of oil and gas assets near the end of their life that were divested, and the new owners have sort of failed to decommission those facilities appropriately. And the government down here is actually, the taxpayer effectively is paying for that decommissioning work. So that's an unacceptable outcome from a societal perspective, and the government has stepped in and really tightened up laws in that regard. So I wouldn't be surprised to see similar instances around the world.
Yeah, that was really useful. Okay, so I know with Tom, we have Tom with us. Sorry to keep you waiting, Tom. I do have some questions for you. Thank you for patiently waiting. So one of the arguments is that we need to introduce some market forces, enable not just the companies directly involved with the production of CO2 or greenhouse gases in general, but allowing other companies to get more involved, and carbon taxes and carbon credits and offsets is one way to go about it. So Tom, in your view, do you think carbon credits have a much bigger role to play going forward? And do you think that this would be a viable way for companies to decarbonize more aggressively going forward?
Yeah, look, thanks, Ben, and it's been a really fascinating discussion to tune into. I think the short answer to that is yes, in the sense that the carbon market has been there for some time and has a really positive role to play in terms of primary project origination. And I think it's not just about utilising that market, but also about giving corporates the ability to participate in that market. So one of the things that's really struck me listening to the conversation today is the role that the investor community can play in sort of putting the guide rails in place for allowing their investee companies to actually take action. One of the things that at the sort of at the ground level, if you like, where we interact with companies, is they are paranoid about doing something, because if they do the wrong thing, or they are seen to be doing the wrong thing, then there will be a very aggressive response, or potentially aggressive response, and that's something that naturally management will shy away from. So I actually think before we get to talking about market mechanisms, one of the positive things that the investor community can do right now is form their own view about, for their investee portfolio company, what are appropriate actions that are inbounds or out of bounds, and actually actively communicate that to their clients, not to their clients, to the board and to the management, to actually kind of allow companies to take the steps that are there. Because carbon markets are there and are available to be utilised, and we've seen significant increases in activity in the voluntary carbon markets for quite some time. I actually think the voluntary carbon market is a more robust space to be than compliance markets, because history has shown us, unfortunately, that compliance markets do have this tail risk associated with changes in the political winds, or changes in the international environment. And obviously we are where we are sitting here in 2021, having relied primarily on that sort of approach. So I would encourage. I think it's consistent with the concept of harnessing the capital markets, harnessing the investment community to utilise those frameworks that are there, and kind of give companies the permission to be good, not perfect.
Thanks, Tom. That's really insightful. And maybe to circle back the conversation to point Nick on these carbon markets, would you be pushing companies to get more involved with exploring, like Tom said, voluntary could be very interesting as well. What are your thoughts, Nick?
Yeah, I believe the most appropriate, perhaps, shall I say, the most responsible approach, in my view, is a three-step approach: measure, reduce, then offset. So we encourage our investing companies to not only measure their Scope 1 carbon emission, but also measure their Scope 2, and perhaps also to measure the Scope 3 emissions. The reason why I mentioned this is based on our engagements with our investing companies, we noticed that a lot of them are new on this journey, and some only make Scope 1 carbon emission disclosure. So for the time being, we do not encourage carbon offset. Instead, we think it should only be used as a last resort, actually.
Oh, that's interesting. So we have some slightly opposing views on the panel today. Perhaps, Tommy, do you have any ideas or suggestions? What sort of frameworks that Malaysia could look at? Maybe even at the primary level, originating some of these credits, for example. And what lessons perhaps can we learn from some of the early implementers?
Yeah, sure. So look, I think the role of carbon offsets is one that people have different views on. And I think if we cast our mind forward to 2050 and the end outcome, then no one sitting here saying that that we want to for example, continue to, if I developed a technology today that I could magically put a vacuum cleaner in the air and suck out all the carbon, are we necessarily saying that we would keep the entire thermal coal industry operating, for example? Well, obviously the answer to that is no, that's not the direction the world's heading. But I think the bit that gets missed a little bit with that narrative about do you offset or do you not is offsets provide the ability to do things in the immediate term, often at relatively modest cost. They do generally represent the first step of a company in terms of moving towards what that 2050 state is. I think it's impossible to underestimate the mentality shift that needs to go on within a company and the way companies do things. So while from the outside in at the high level, you can say, no, we would prefer to remove remove emissions entirely, and then offset what's remaining. That kind of assumes that there'll be an offset market available when you get to that point in time. And if you don't nurture it now, then the answer is that there won't be. The other thing, it kind of comes back to where this conversation started, which is a discussion about ESG. And people focus about offsets with a very, very strong focus on the E outcome. But the carbon credit market itself, its genesis is in the Kyoto Protocol back in 1992. And the UN created what was called the CDM market, the Clean Development Mechanism. And the entire objective of carbon finance when it was first established was actually to pair environmental outcomes and developmental outcomes. And I think if you kind of take a narrow view of the world, then you say, well, one way that this whole thing could play out is quite simply that we have a significant increase in carbon abatement activity or carbon removal activity, which is directed around what we call the global south, and which is basically where the wealthier countries of the world can afford to pay the less wealthy countries in the world to change the way that they behave or change the way they use their land in order to support the kind of environmental outcomes of the whole. And I think sort of what gets missed a little bit with some of these projects is the opportunity to actually contribute to the S, because a lot of them are really about putting investment into a local community. It needs to be structured the right way. The principles all need to be aligned. Like, I'm not saying there doesn't need to be rules of the road around that, but I also think that there's an opportunity for companies to attack this E issue but do it in a way where it's also additive to S as well.
Thanks, Tom. That's a really great point. So the next question, maybe to tie things together, how much of the burden of this ESG decarbonization journey more broadly, falls on regulators and policymakers? Tom, you talked about, there needs to be rules still, but you also lean towards some of the voluntary carbon markets. Maybe I can direct this question first to Charles. How much of the burden falls on regulators?
I hope I don't have to quantify that, but yeah, look, this has been brought up, I think, as kind of a false dichotomy. So the idea being that ESG investing is a distraction from regulation, and by putting money toward ESG-friendly funds, etc., we're actually not helping the cause. And this is something that was put out by the former, some high-profile figures within ESG. And I'd say it's a false dichotomy because certainly investment and investors can move the ball forward very clearly and much more quickly than government, of course, which is crucial because we really don't have time from a carbon perspective or for many of the other things that we'd be looking at around labor rights, modern slavery, etc. Absolutely. ESG has, the investors across asset classes need to move this forward. There's certain areas where government is absolutely crucial as well, be it in basic science, and also for things such as when these assets are moved into the hands of private equity players, like we need to prevent the outcomes that Mark was talking about earlier. And that really can't be done by investors. That has to be through governments. And we're seeing this as well very clearly that the regulators, government effectively have been pushing this forward to clean up and prevent greenwashing in the ESG investment space, which is great. So basically investment moves it forward, but at the end of the day, we still do need those regulations, and they are coming into place.
Thanks, Charles. And Mark, who do you feel carries a bit more of the burden? Which one is a bigger driving force when it comes to, from the corporate's perspective?
Yeah, I mean, I think corporates need to be cognizant of the direction regulators are going, but they also need to own their own path and create an investment profile that's acceptable and desirable to the market. So if they purely do the minimum required by regulators, they probably will fall short on investors' scorecards.
Thanks, Mark. And just to round it off with Tom, you did mention you're not too keen on the structured markets that regulators can create, carbon taxes. But are you optimistic that there could be a wake-up moment at some point where regulators, at least in some markets, make that big leap, it really brings the carbon offsets and carbon taxes all to the mainstream? Do you think we are waiting for that aha moment?
Well, the aha moment that's probably missing, I think, Ben, is the issue of transfer price of costs, ultimately. That's what this all boils down to. So if we take a simple example of a power grid that needs to be decarbonised, and over time you remove all the fossil fuel generation, you're going to replace that with a mixture of renewables and storage that is going to give you an LCOE outcome that is likely to be higher than what the current outcome is. And that's fine because the current outcome doesn't price the externalities of the producers. But I guess the underlying issue that needs to occur is that the transfer price needs to make its way through to the end consumer, and that needs to be managed in a way that is acceptable because it's a challenging issue. So to me, I think the role that government could play in how it tackles whether it gets involved at all or not is part of sort of trying to grease the rails a little bit for helping people understand what the kind of the change in costs are going to look like over time, and getting sort of preparing the framework that allows that change to occur. Because I think one thing that like all of these activities would be occurring, I think, in a much greater scale if that transfer price was much clearer. And so that's one element for government to consider.
Thanks, Tom. That's helpful. So, just moving on. This question is for Puan Nick. Do you see any advantage in being a first mover in ESG investing from the perspective of protecting your portfolio?
Yes, indeed, Ben. It has enabled us to have a head start in building our own internal talents and capabilities. This has resulted in us being able to put in place internal policies and guidelines, and also has enabled us to be ready when we became a PRI signatory back in 2018. But this area is definitely currently making improvements by leaps and bounds, and all organizations, regardless of when they embark on this journey, they have to keep up with the latest best industry practices. For example, PRI is introducing new criteria in areas of climate change, and like I mentioned earlier, what was the best-in-class ESG practices a few years ago are no longer sufficient. So in our effort to integrate ESG into our DNA, we must ensure that it's not merely a box-ticking exercise. So I do acknowledge that some of us are at different stages of this journey toward ESG incorporation into all of our practices. So we need to make sure that it is inculcated within the culture of each organization, each investing company and organization. So only when it becomes a culture for us to that ESG matters are part and parcel of their daily activities and also operations, so we can keep that momentum going in the long run, and therefore can keep abreast with the ever expanding requirements and approaches. So we believe that this journey is a marathon, and definitely is not a sprint, because not only from a country perspective that we are at various degrees on this journey in terms of implementation towards net zero kind of economy. So I think depending on the stages that we are at, as long as we are on this journey together and assist one another, I think we are on the right track.
Thanks, Puan Nick. And similar question for Charles. Again, more from a regional, global perspective. Some funds that maybe were early to sell, let's say, coal assets before the prices corrected, the guys who've been ahead of the curve on that, from that perspective, look like they've done well. What are your thoughts on this sort of move first, ask questions later, and and abandoning some of that guiding the transition and stewardship that was raised earlier in the conversation?
Yeah. Well, no, good question. Well, first, I don't think you can abandon the stewardship or that transition consideration. It's just not optional at this stage. But the idea of moving earlier, naturally, that would be better. If we just take a very simplistic view in the interest of time, then you do have AUM flows. And again, going back to the beginning, you can see that there is more money chasing these investments that would be greener, these investments that would be more ESG friendly. And that transition is ongoing. And particularly in Asia, we're in the very early stages of that transition. Now, during that time, the cost of capital for those companies, the multiples, the valuations will increase. I mean, that's simple. More money going into the same size pot. So you want to be early for the transition to capture that. And that's even the detractors, or kind of the backlash against ESG, acknowledge that during the transition period, you will get this outperformance. And that's really what you want to capture. So yes, definitely the earlier, the better.
Thanks, Charles. And just to balance that view, I want to bring Mark in on to talk about risks. Obviously, there's a lot of risks in your sectors. If the companies are not quick to adapt, or they're not able to adapt over a longer period of time, there's a lot of downside risk. What sort of volatile transition should these investors think about when it comes to owning some of these assets longer term, and how should they think about managing this risk if you want to still take a stewardship role in an oil and gas company in a decarbonizing world?
Yeah, it's an interesting question. The oil and gas companies have a unique set of challenges. The first step typically is to decarbonize their existing production. The world is still consuming a lot of oil. Demand has not rolled over yet, and so keeping the energy system supplied is still paramount, but doing it in the cleanest way possible. So minimising flaring, containing any loss incidents, and just running businesses better. There has been a lot of focus on that for some years already, but there are still some companies that need to catch up in that regard. And the more challenging aspect, the second step, is pivoting their business to create lower carbon energy products for customers to consume. And so hydrogen is one of the most mentioned topics on investor calls with the oil and gas companies. And I think as a group, the companies are struggling to work out, how do we actually make money from hydrogen production or distribution. And as we sit here today, it's still quite difficult for a lot of boardrooms to make those decisions. I think on the other end of the spectrum, the key risk to worry about is stranded assets. So, traditional coal deposits or oil and gas deposits that aren't yet developed. We're heading into this twilight phase where you've probably got 10 or 15 years to get those into development if they're going to be developed, or they will miss the window and they'll be written off. Some of those assets already are facing impairments. And so I think understanding how much of the value of a certain stock that I hold is tied up in what could potentially become stranded assets, I think, is also another way of thinking about it. How do companies make that successful transition? In a lot of cases, it's going to require M&A and bringing in new executives with new ways of thinking and new capabilities. And the energy system is going to become a lot more electric. So moving from liquid fuels to people with physics backgrounds as opposed to chemistry backgrounds is going to be a big trend.
Thanks, Mark. And maybe I see we're coming up to the hour. So last question here is around technology. I think we've talked a bit too much about assets, but not a lot about technology. Would we want to be investing more in companies that own technologies that can allow us to, decarbonize, right? And I think this question can be open to Tom as well, because I think there's some technologies being discussed for like carbon capture, for example. So maybe Mark, what are your thoughts on technologies, and anything catch your eye out there in the space that we should be keeping a close eye on?
Yeah, I think when I think about the renewable technologies that exist today, they're fairly commoditized. Solar PV is heavily commoditized. Wind turbines have some differentiation, but not a huge amount. We did a call with a company last week in California that has a quite a unique thermal solar solution with some storage capabilities, using AI technology to help direct mirrors to maximize the sun capture and be able to store that to create a baseload industrial style electricity profile, which solar PV just can't sort of create. I do think there's going to be innovators that think of new ways of harnessing renewables, and those technologies will be quite valuable if they're patented appropriately. The other thing I would say is the service companies It's much easier for services-oriented businesses to pivot to offering lower carbon services than the poor resource company who's left holding a resource that's going to become stranded. So asset-light businesses will naturally probably fare better through this uncertain transition.
All right, and Tom, any technologies getting you excited in your space?
Oh, I think an extension of what Mark was saying, there's a technology opportunity still waiting in what we call deep storage. So the ability of an asset to store energy, not just for 1 hour, 2 hours, 4 hours, but for 8, 12, 24 hours. That's something that is still missing in a cost-effective way, because just building grid scale kind of 1C, 2C, 4C batteries is currently an expensive way to do that. In the carbon space itself, CCUS storage has obviously had a lot of promise for a while, also has not delivered. That remains a contested area. I do believe that if someone is able to crack that nut, it will probably, and it becomes cost effective, it will probably prosper quite well, because it will be the least disruptive path forward for substantial climate mitigation, despite its unpopularity in some quarters. But that's a little way off yet, I suspect.
All right, I think those two final points are quite encouraging, a bit more optimistic view of the future. Yes, so we're out of time. Thank you so much, everyone, for dialing today. It's certainly been a very productive discussion. Puan Nick, Charles, Mark, Tom, appreciate the time. Stay safe, and again, thank you for your time.
Thank you.
Thank you.
Goodbye.
Thank you. Cheers.
Bye-bye.